we're back talking about a SEP IRA or solo 401k. So maybe you have a question. Call me right now. We are taking listener calls live, uncensored, unscripted right now. 800-321-0710. Remember, this show is made because of you, the listener, and your calls. So type into the chat box of YouTube, go to youtube.com, search for The Financial Quarterback in the chat box, and you get to see any and every financial question that you have answered live, uncensored, unscripted. Call us now, 800-321-0710. So we're talking about the SEP IRA, but one potential downside of a SEP is that Roth accounts are unavailable since contributions are made based on a percentage of income for the year. If you have a low income year, your ability to contribute to a SEP is limited. In addition, plan loans are not available with a SEP IRA. What is a solo 401k? A solo 401k, also known as an individual 401k. The solo 401k is one of the least utilized things that I see by entrepreneurs and self-employeds. And it's available only to you if you're a business owner and spouses involved in the business and business partners. And you can sock away up to $19,500 or an additional $6,500 if you're 50 and older. So you can sock away a lot of money. Additionally, employer profit sharing contributions of up to 25% of compensation can be made. So you can sock away up to $64,500 if you are 50 or older in 2021. That is huge. So let's say you're paying $100,000 of income and you're like, dude, I'm 50 and I haven't saved anything for retirement. Live like a pauper, live on a couple grand a month, and you can bank $58,000 if you're under 50, $64,500 if you're 50 or older. I'm going to ask Ernesto, have you heard about this solo 401k? Like, were you, before you did the show, or maybe even after doing the show, have you heard about the solo 401k?
I haven't heard about the solo 401k, but as a small business owner, it sounds appealing.
Oh, it's fantastic. Now, depending on the custodian chosen, a Roth option may be also available, but not for the employer profit sharing parts. Likewise, plan loans can be an option. The employee deferral option allows people to contribute up to the maximum $26,000 as long as their compensation is at least these levels. Comparing the two plans, the max salary deferrals are made. The solo 401k can generally be maxed out in terms of total contributions at a lower compensation level than with the SEP. A lot of accountants push the SEP. You need to be turned on to the solo K. That's my biggest takeaway from this segment. And call us at 888-988-JOSH for the 45-minute ultimate financial game plan. We had people this week call us and they wanted to know, how do I solve for the dreaded income gap? And I did a whole workshop on that this week. And basically, I could teach you how somebody with $55,000 a year in retirement could potentially go to $110,000 depending on the amount you have saved in retirement. We also went over how if you are married, the death of a spouse, if you lose their Social Security check, if you get your pension cut in half, that could have devastating consequences to a loved one. And one of the things we offer at our 45-minute ultimate game plan is you get to kill your spouse off. Well, no, not like that. It's a simulated experience. So the simulated experience is, let's say there's a couple, Ernesto and Ernestina. Is Ernestina actually a female name?
It would be an odd couple, and it's a real name.
So Ernesto and Ernestina are married, and they have pension, Social Security, and some retirement income. What most people don't realize is that if one of you dies, you lose one entire Social Security check. And generally, half of the pension gets cut in half. And you know what? Ernesto doesn't eat that much. Now, what about if Ernestina dies? I used to be like, well, I'm the primary breadwinner. I don't need life insurance on my wife. And then I was stuck at home raising 6 kids. And I love raising 6 kids with my wife. Alone, single daddom is you might say, well, what's happening to you? What's happening to your marriage? Well, if you've been under a rock, our child's been hospitalized for a number of weeks, and pray that he gets out swiftly and can breathe. But he's been in for like a month. And so my wife takes care of him every night, watches him, and then I'm watching the children. And if you call us at 888-988-JOSH and request the 45-minute ultimate financial game plan, you may hear my kids in the background. Yesterday, they stormed the gates of my office. So whoever was the idiot that built my house before me, they did not put locks in the home office. So I will be locked. I'll have to get my handyman, who isn't me, to put a lock in the home office. And they led to tell me that, I don't know, the pool guy wanted something. And I'm like, dude, I'm working here. It's like a life or death situation. The pool guy wants to speak with you. I mean, they're very conscientious. So we're going to talk about Rothification. Could be a song. Rothification. So including how the Secure Act. So I'm going to talk about how the Secure Act has upended retirement planning, uncertainty in tax planning, and IRA trusts, and why they're still needed. And lastly, Congress's move towards Rothification. We're getting a lot of questions about new rules in regards to IRA beneficiaries and Roth IRAs. Call us right now, 888-988-JOSH, if you want the 45-minute ultimate financial game plan for retirement. I'm going to give you 5 key takeaways on IRA planning that you must know about. But first, call us at 888-988-JOSH for the 11 ways to save taxes review. And you get the 45-minute ultimate financial game plan where we show you protection strategies for your assets, asset protection, tax savings, and growth strategies in these uncertain times. So call me right now, 888-988-JOSH. And next up, I'm going to give you 5 IRA takeaways. If you have an IRA, you're going to want to tune in to the next segment. 888-988-JOSH, 888-988-JOSH. And if you have a financial question, we are answering your questions all hour, 800-321-0710. This is Josh Jalinski, the financial quarterback. Don't touch that dial. Ernesto said, I think, what did you say, Ernesto, about the simulation?
I think the killing off your spouse simulation is going to be a very popular reason for people to call in.
Especially a lot of you after COVID at 888-988-JOSH. You want the simulation. Now, we are not advocating killing your spouse, but too many of you said, well, I've done a Monte Carlo simulation. I've done a financial plan, but you have not seen what would exactly happen to your income should your spouse die. Now, we get sometimes people like me who say, I'm the chief breadwinner. I don't need to plan for that. My wife is beautiful and she supports the home and she's a great homemaker, but you know what? She doesn't bring any income in. Well, how could you replace such a woman? I could not. I could never replace my beautiful, darling wife. You would have to really pay somebody probably $250,000 a year to replace some of the functions. But her job is priceless, $1 million a year. And you might say, well, how do you get $250,000 a year? Well, let's consider educator, counselor, sometimes cook, sometimes maid, or if you have a house, a husband, let's say you're a wife who works and brings in a lot of the bacon, and a lot of women do that now. Now you have a house husband. You're going to need to hire a manny. It sounds like a joke, but it really is true. I mean, to hire someone to live with your kids, so you need life insurance. Or if you don't need life insurance, you need to have enough assets where you can self-insure. Because, I'm doing a lot. And then what happens is things start to suffer. Like, whatever. So for me, my wife is invaluable. Now, maybe your husband's invaluable. Maybe your wife's invaluable. Maybe they're not that valuable. But they're valuable from an economic perspective to the household. That's why you want to call us at 888-988-JOSH and walk through the experience of a simulated experience where your spouse isn't there. When I talk to couples who go through this experience, they are enlightened by how much income their spouse produce. You may be making $100,000 a year and slaving. You might be feeling like, we're just not even getting ahead. You think you're not getting ahead now? Wait till you don't have two incomes. Wait till it's just one. So people need to go through a simulated experience of death, of disability, of long-term care. And you might say, wow, you're a depressing guy. Well, it's not about that. It's a liberation. If you can plan for the certainty of a particular event, i.e. death, it can cause you to budget things in like going on a vacation every year. Building memories so that if there is an early demise, you didn't just plan for tomorrow, you lived for today. So 5 IRA takeaways, and we may bring this into the next hour because this is a critical update. Critical update. When the Secure Act became a reality in 2020, it killed the stretch IRA. What is the correct interpretation of the new 10-year rule, especially in light of the recent publication by the IRS? In its revision to that confusing publication, the IRS had to make revisions to correct the impression that RMDs would be required during the 10-year period. It is clear as well that there is a lot of interest from both advisors and retirement savers in potential replacements for the stretch, such as life insurance or charitable trusts. So it used to be that if you died, you didn't have to worry about your IRA too much. Now you do, because the stretch IRA is no more. So we'll talk about that takeaway. And then many believe we are headed for tax increases. Takeaway number 2. There is much uncertainty when it comes to tax planning right now, stemming from concern that today's rates won't be around long due to the Biden tax hikes. If that's you, many believe that historically low income tax and federal state tax levels are likely to rise in the near future. If you are concerned about that, call us at 888-988-JOSH, and we will give you what to happen if taxes go up review. Call me now. 888-988-JOSH. 888-988-JOSH. 888-988-5674. And we'll throw in the income for life blueprint when you schedule and keep your no obligation review at 888-988-JOSH. 888-988-JOSH. 888-988-5674. I'd love to meet with you, shake your hand, whether it's through a virtual Zoom type webinar where we get to meet one-on-one.
And WAXQ HD2 New York, an iHeart radio station. Available everywhere on our free iHeart Radio app. Number 1 for music, radio, and podcasts. All in one.
We're back. This is Josh Jalinski, the financial quarterback, coming to you live, taking your questions on all matters financial. We talked about the idea of a simulated experience where you can simulate different things like the death of a spouse, where you can simulate a long-term care illness, where you can simulate disability. Why is that so important? Because that's the big three: death, disability, and dismemberment. No, it's actually death, disability, and unemployment. So Ernesto, what do you think about that? Did you even know that you could simulate the death of a spouse?
I did not, but it sounds brilliant. Most people don't plan to be injured. Most people don't plan. You never dream that someone that you love, especially a spouse, would pass away. So, at first, it sounds it sounded very it sounded funny to me. I'm sorry. I had to mute my mic. I was cracking up over here.
So here's the thing, though. U.S. life expectancy. This just in from Chief Compliance Officer of the firm, Tom Clancy. I heard this report came out this week, but life expectancy at birth for the total U.S. population was 74.5 years if you were a male. That was considered young a few years ago. COVID changed that. For females, life expectancy declined to 80.2 years. So we had a 1.8 and 1.2 decrease in life expectancy. That's dramatic. It's also a lot better than you thought it would be, after a pandemic, but it's bad. So why did it drop? Obviously COVID. Also, people didn't go to the doctor as much. So cancers went undetected, things like that. Drug abuse went undetected also. A lot of people died of drug overdoses. So the point is, maybe you woke up this year and your spouse died and you're like, well, this really hits home. I'm sad from what I'm going through. Yeah, we're trying to make light of it, but everybody should be doing 3 scenarios in their retirement planning. 4, retirement planning: living too long, dying too soon, getting disabled, or getting unemployed. Those 4 things are things your retirement plan should be able to envision. And we can help you do that at 888-988-JOSH. A lot of our clients, we've been dealing with a lot of people, they're worth like $1 to $10 million. So they've arrived, so to speak, and they don't do proper legacy planning. So the government's going to get, half their IRA or 40% of their IRA when they die. And you know why they don't plan, Ernesto?
I don't.
They don't go through the death and disability scenarios. So they always think, oh, what about this? Oh, what about that? So they don't ever pull the trigger on gifting strategies or trusts or life insurance, because it's like, well, what if I'm going to need the money due to XYZ? Well, if you planned, you don't have to worry about it. So establish a trusted contact, get a will, establish proper documentation. Another person this week found out they died intestate without a will. I mean, there's a lot of things that people do not like to think of their untimely passing. Now, here's the thing. I'm all for faith. I'm going to live to 120 by the grace of God. But if not, I want my wife and kids okay. That's the ultimate act of love. So call us at 888-988-JOSH if you want the simulated experience of a retirement wealth simulation at 888-988-JOSH. Next up, we're going to go to the phone lines for our listener-inspired questions at 800-321-0710, 800-321-0710. If you have questions on stocks, bonds, annuities, mutual funds. We're talking about 5 takeaways from IRA planning. So this was a workshop that Ed Slott did for advisors, and he found that many of them were clueless on what to do with the new 10-year rule. We are not clueless on that. Number 2, many were headed for tax increases. Number 3, the net unrealized appreciation tax break is currently generating a lot of interest as markets boom. The NUA tax break allows plan participants who take lump sum distributions, including in-kind distributions of employer stock, to take advantage of favorable capital gains tax rates on stocks within a 401k. That's a major tax benefit. With markets way up and many fearing that capital gains rates are going up and many taking early retirement due to a pandemic, this is the perfect storm for NUA. NUA stands for net unrealized appreciation. So if you have employer stock within a 401k, you gotta call us 888-988-JOSH, or we have a lot of topics we're covering today. And if you want your questions addressed, give me a call, 800-321-0710. You try to call the other financial shows. People, they're not picking up the phone. Hello? I got a question. We're here for you. You get to ask me any financial question you have at 800-321-0710. And you get to see what I look like on the youtube.com review. So Ernesto has a question.
A lot of couples, a lot of my friends, they're not married, but they have a long time, they've been dating the same woman for a long time, and they've been building a life together. Some of them...
Failure to commit?
It sounds like it. It's a good thing my mom can't call into this radio show. But so what kind of advice, other than getting married?
On line 3, we have your mom.
What do you have for couples other than to get married? How would you advise couples that have actually been building a life together but are not yet married?
Well, I don't know why you haven't gotten married yet, number 1. Number 2, if you, for some reason, don't want to get married, make sure you have a contract, a legal contract about who gets what. Because, we've had couples we've dealt with, like, okay, the man doesn't want to get married. The woman is living with the man for 20 years, and if he dies, lady, you're screwed. His kids from the first wife are getting all the money. And oh, by the way, the beneficiary designations weren't updated. So you got to at least have a contract who gets the house, who gets the car, who gets the possessions, because even if you have a second marriage, this stuff has to be spelled out. And kids from the first marriage moving in on the second marriage. One time I heard of a couple, the spouse, the second spouse, the man thought the wife would be gobbled up easily because she was such a beautiful woman and vivacious personality. Turns out didn't happen, and he didn't leave her as much as he should have. And the kids from the first marriage got all the money, or got a large portion of the nest egg. And, it breaks my heart. Broke my heart to see that. And, here's the thing, folks. What are you going to do if your spouse dies, or if your significant other? Maybe you get a civil union if you're against marriage for some reason. Maybe you have a legal contract drawn up. But you just can't, that's why in our culture where, if you don't want to get married, get a prenup, maybe. Have something where assets are spelled out before you enter into a relationship. Oh, I'm not in it for the money. Well, of course not. But, you have to think through what happens should your loved one dies and you're not married. Or what about if you don't have kids, right? Like, who gets all of the money if you die with no kids? Would you want it to go to a charity? Would you want it to go to a niece or nephew who loves you? Would you want it to go to the one who took care of you? Or would you want it to go to people who didn't really care about you when you needed? So all of those things, you want to write down what you're doing. So we're talking about 5 takeaways on IRA planning. The Secure Act has upended retirement planning. Number 2, many believe we are headed for tax increases and they don't know what to do with it. Number 3, NUA tax break if you have employer stock within a 401k. Number 4, IRA trusts may be less useful, but for some IRA owners, they will still be needed. The Secure Act may have downgraded trusts as a planning strategy for IRAs with the new 10-year rule for most beneficiaries, including trusts. However, people recognize that for some situations, like minor beneficiaries, special needs children, and those with credit issues, a trust still may be a good choice. So let's say you have a kid with a credit issue. If you give them money outright, their creditors can attack that money. Advisors and their clients are eagerly waiting on the Secure Act guidance from the IRS to fill in the gaps on how the rules for trusts as IRA beneficiaries will work going forward. Now, Roths still rule the day. But first, we're going to talk with Jimmy. Now, by the way, we are ever nearing the conclusion to our name game. For those of you who don't know, it's taken us many weeks to name our beautiful son. And we will be revealing the name probably next week. But first, Jimmy, you're on with Josh Jalinski, the financial quarterback. Go ahead.
Morning, Josh. I've been listening to your show for a few years now, and you've been talking about like a volatility buffer. And I understand the whole concept about it. You know, when you start making withdrawals from your retirement plans, that, you know, when the market is up, you know, you have to sell less shares. When it's down, you have to sell more shares. So when the market does take a downturn, you dip into this volatility buffer. So where would you, park the money in the volatility buffer? Would it be, a bond fund, a money market? Obviously, you want to preserve the principal. Am I right, on the right track with that?
Well, it depends on you and what your objectives are. But number 1, you could use a cash account. Number 2, you could use a money market. 3, a CD. 4, you could look at cash value and life insurance. I like that as a volatility buffer because the money inside of a cash value policy grows tax deferred and can be pulled out tax free. And you could also look at munis as well as a volatility buffer. The whole idea is you want money that is non-tethered to the market. Now, the one negative of muni bonds is that if there is a market crisis, most likely that will affect the abilities of municipalities to collect on tax revenue. So that may be something that you don't exactly want to do. So volatility buffer is basically a strategy that I've talked about for years. I talk about it in my book, Retirement Reality Check, which if you've been under a rock and haven't gotten it, go to retirementrealitycheck.com today. Purchase the book, retirementrealitycheck.com, and you get 3 free gifts when you buy my book. But does that help you, Jimmy?
It does help me, but a few years ago when I started my volatility buffer, I had it in a CD, which is basically paying nothing. So I live in Queens, and I had opened up through a large mutual fund family, New York State long-term municipal bond fund. And even in the market downturn of COVID last year, the net asset value really did not fluctuate much. And I've been reinvesting, the dividends every month. I've kind of gone that way.
Well, you could do that way, but the problem with that is if interest rates go up, that muni bond fund could lose precipitously. So muni bond funds did fare much better during the COVID crisis than during the interest rate hikes of December of 2018. Generally, for about every 1% hike in interest rates, a bond fund's going to go down about 8 to 10%. So personally, for volatility buffer, for me, I want things that are principal protected. Could be a fixed annuity, like a 3-year, like the old bond ladder. Could be treasuries. Could be cash value insurance. And the reason why I like that is a lot of cash value policies will have a guaranteed rate of 3 or 4% after the cost of insurance. So you still have to pay the premiums and stuff, but that money can be liquidated at any time, the cash value buildup of a policy. So I generally favor that. I'm not against municipal bonds, and you can certainly use them. The idea of a volatility buffer is you should have 1 to 3 years of living expenses in that, so that your rest of your money can be in the market, growing unfettered. And if you time wrong, you can just let it rip, let the market ride out the storms, and be a rider on the storm, as Jim Morrison used to say. So I hope that helps you. We're going to take more of your calls at 800-321-0710. When we return from the break, go to youtube.com, type in The Financial Quarterback, and you get to see my ugly mug live, unscripted, uncensored. And Jimmy, if you have more questions on volatility buffers, you can stay on. Folks, give us a call, 888-988-JOSH, and you get the Income for Life Blueprint and the 45-minute ultimate financial game plan, where we go over asset protection strategies, tax saving strategies, and growth opportunities in these uncertain times. And Jimmy, man, good listener. You're trying to do some really good strategies like the volatility buffer. I salute you. 888-988-JOSH, 888-988-5674. We'll be back after these messages.
The preceding program was sponsored by the Jalinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jalinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.